We are now going to look through learning objectives 4 and number 5. So we'll look at using the accounting equation to analyze business transactions, as well as we're continuing on preparing the financial statements and looking at the balance sheet. So the textbook goes through accounting for business transactions, pages 15 to 19. And this looks at all of the ways that transactions are recorded in bookkeeping. So whenever a transaction happens, maybe buying an asset or paying an expense, earning revenue, these transactions need to be recorded in the accounting records. And again, a quick reminder, just the business transactions, no personal transactions. So the summary of all of these transactions are where those balances come from in our revenue, expenses, and accounts that we looked at on the income statement, and as well as our asset and liability accounts that we're going to talk about right away. I want you guys, just on your own time, to go through these transactions in Exhibit 1-11 on page 19. So read through them and take a look at that exhibit. It is important, it's just that all of the information's in the textbook, so I'm not going to make a video about that. As well, in the next chapters, we're going to learn about how to do journal entries, which is how these transactions actually get recorded in the bookkeeping. So I still think it's a good idea to take a look at those, get an idea and see how things are working in the accounting equation, and then we'll go through in more in depth and in the videos in the next future chapters. So we've looked at the income statement, we looked at the statement of owner's equity, and now we're going to look at the third statement, which is the balance sheet. And just to note, the fourth statement is the cash flow statement, but we don't actually cover that in Accounting 102. So this gets covered in detail in Accounting 103. So you're not responsible to know the cash flow statement in this course. The balance sheet is sometimes also called the statement of financial position. We will refer to it as the balance sheet. And this lists all of the assets, liabilities, and the owner's equity of an entity at a specific date. So you can see the first two that we talked about were both for a period of time. When we get to the balance sheet, it's at a specific date and time. So whatever the ending day of the period of time of the balance or of the income statement and statement of equity, that's what date we do the balance sheet for. And if we think about why this is, think of cash as an example. Cash is an asset in the business. Well, we just want to know at this specific date, what is our cash balance? You can't show one number for cash for a period of time, because that could change every day or even several times within the day for a business. So for the balance sheet for these assets, liabilities, and equity, we're now saying one number at the end of this period, so at that specific date. Right, so the balance sheet and the accounting equation go hand in hand. And these are assets, liabilities, and owner's equity. So assets are economic resources controlled by an entity that are expected to provide future economic benefit. That are expected to provide future economic benefit. There are two important points here in the definition for assets. The first one is that they are assets that are controlled by the entity. And for our purposes, this means that they are owned by the entity. So they actually need to be owned. And then the second important part is that they are expected to have future economic benefit. So they actually have to be useful for them to be considered assets. An example you could think of here is a grocery store who sells apples. Apples are part of inventory. They're going to be sold to customers. So they would be an asset as long as they have future economic benefit. So if they're good, fresh apples, yes, they have benefit. They would be an asset. If they've gone rotten, no customer is going to buy them. They're not able to be sold. So these actually have no future economic benefit for the business. So they would be what's called written off. And we'll go into that in the future, but that's just an example. They don't have benefit, so they're no longer an asset. We would do an adjustment and move them out of assets. Examples of some assets are cash. Obviously, that's a good thing for a business to have, to be able to purchase items. Land that a business owns. So again, this is land that they own. That would be an asset. Buildings. Again, this first point, they would be owning that building. If they're just renting it and using it, because they're not owning it, it wouldn't be an asset to the company. So I'll just put here buildings that are owned. Inventory. Inventory are any goods that are available to be sold to customers. And then another example is what's called accounts receivable. And you'll often hear me or other accountants just call this AR for short. Again, just quick form accountants like to have those acronyms. So AR is accounts receivable. An accounts receivable is something that is still to be collected by the business. So whereas if you and I go to a store, for us to buy something, we've typically got to pay cash right away. But businesses, when they are purchasing from other businesses, so if a company purchases or sells supplies in wholesale to other businesses, typically the payment doesn't happen right away. They're often given an invoice and they have 30 days to pay for that. So the company that is doing the selling, they have accounts receivable because they have still to collect or to receive that money from their customer. So if it hasn't been collected yet, it is accounts receivable. Now, if we look at liabilities next, liabilities are really the opposite. These are debts and amounts owed and payable to creditors. Or we could consider creditors as outsiders. So these are entities outside of the organization or out of this business, like the bank or suppliers. So someone outside the business that is owed some sort of money or other item. Examples of liabilities are a bank loan. The business needed to borrow money from the bank, but they now need to repay that, so this is a liability to them. Accounts payable is another example. And this is really the opposite side of AP or AR, and it's often referred to as AP. So accounts payable, as I said, is opposite of accounts receivable. So where one business is able to, or we talked about someone may sell supplies and the company who sold it has that accounts receivable. Well, the company that purchased the supplies because they haven't paid yet, they have the same amount, but it's now the opposite. It's an accounts payable because they need to pay that to the supplier still. So those go hand in hand. They are just opposite sides of the same transaction. So one of the businesses has the receivable and the other business has the payable. Another example is salaries payable. Often employers have payroll cut off, or you have to have your timesheet in on a Friday, but the payroll department needs time to process that, so you might not actually get paid till the following Friday. So say the first Friday where the cutoff is December 31st. If that's the year end of the business, but they're not actually paying those wages to the employee until the next Friday, so January 7th, they have this payable at year end. The employees have worked till the end of December. They deserve that pay. They have earned it already. So it is an expense in the company, and we would have a payable at that date for any of the salaries not paid yet. And just to note that liabilities, in the definition here, it says debts and amount owed and payable. So it may not always be cash that you have or that you owe to someone. You could owe them a product, or you could owe them a service to be done. So it's cash that's payable or other amounts that are owed as well. Owner's equity we discussed in the last video, but we'll go through it again here quick. These are the owner's claims to the business assets. And remember, we start with our opening balance, we add in any investments, we add net income for the year, and we take away with any withdrawals. And that got us to our closing balance of owner's equity. So in the example we did for Harley's Tough Toys and Tasty Treats, we calculated Harley capital ending. So that ending balance in owner's equity, which is called capital, another term for it, put that here. That goes now from the statement of owner's equity, and that ending balance gets shown on the balance sheet. Similar to how net income came from the income statement to the statement of owner's equity. So these are the three different categories that get shown on the balance sheet. And the balance sheet is set up to look like the accounting equation. So this is what the accounting equation is. And this top line is the accounting equation. And this second part down here is just a way to explain it. The accounting equation says that assets are equal to liabilities plus owner's equity. And this is really important for you guys to know this accounting equation and how it makes sense, how it works. So if we look at the bottom part and go through this as an explanation, a way you can think of it, way you think of the assets, they're the economic resources of that business. So they are everything a business has. It's just kind of a way to think of it outside of accounting terms. So everything a business has right now. All their cash, their AR, land, building, that type of thing. So everything that they have right now equals or is owed to, first, to outsiders or to those creditors. So first to creditors. You would pay off your liabilities first, then second goes to the owners, or what's left. So everything that a business has right now is owed to first the creditors, and then what's left goes to the owners. So if you think of this, say a business, they decided to close their doors and shut down right now. They would turn all of their assets into cash. So they'd sell their land for cash, they'd collect their AR for cash. So everything they have is now cash. The first thing they would do is pay off all of their liabilities to their creditors. And once they've done that, all those debts are paid. Any cash that's left gets paid out to the owners. That is their claim to the business assets. So that is what owner's equity is. Once the assets are used to pay liabilities, anything left is owner's equity. I know you've likely heard the term assets and liabilities before, but that owner's equity might be new. So if we, kind of another way, like I've said, to think of it, it's what is owed to the owners. And we could redo this or reorder the equation, do a little algebra, reorder things, and actually solve for owner's equity. So owner's equity, if we do that, is equal to the assets minus the liabilities. So that's another good way to think of that the owners get what's left after the assets are used to pay those liabilities. So now we know the accounting equation, and this split here, the assets equals liabilities plus owner's equity, is how the balance sheet is laid out. Here's an example. Again, name of the company, this is the balance sheet, and now it's at April 30th, 2019. So remember, it's at this specific date and time. This is what we have, this is what we owe. So you separate the assets on one side, and then on the other side, we have our liabilities plus our owner's equity to get to this total at the bottom there. And it is called a balance sheet because these must agree, just like the accounting equation. Our total assets must be equal to our total liabilities and owner's equity. So it's a good way to have kind of a check and balance in place here. That if you go to prepare the balance sheet and these amounts don't equal, so your assets don't equal total liabilities and equity, you know that there's an error somewhere. So it's a good check to have. The accounting links together, and it's a good check to have there. Now the balance sheet, the assets are typically ordered in what's called the order of liquidity, which is how fast they can be converted to cash. So because you'd have land for a long period of time, it comes at the end, whereas cash typically goes first because it is cash already. Accounts receivable typically comes next because it's quickest to be collected. You've already sold your goods, you've done your contract, now all you have to do left is to collect that. So that is in the real world, it's ordered that way. For our course, I don't care what order your assets go into in terms of, we'll look at in an example, current versus long term. But within those two categories, the order doesn't matter as long as you have the assets in the right area, liabilities in the right area, equity in the right area. Okay, last thing I want to note on this slide here is that this Lisa Hunter Capital, this came from the statement of owner's equity as it says there. So remember in the last video we went through, we calculated that ending balance, and this is that ending balance. So we calculated in one statement and now we pull it into the balance sheet. And that's laid out nicely here. It may be small if you've printed your slides, so you could look at page 23 for a larger image of this. But it shows that relationship amongst the statements that we've talked about. So first of all, the first thing you do is prepare the income statement, we're calculating our net income balance there. This net income, we've seen, goes into the statement of owner's equity, which is prepared second. On this statement, we're calculating that ending balance in the capital account, which then is pulled down, and third, we calculate the balance sheet. So this balance comes from the statement of owner's equity. And as I said, this flow and this link happens quite often in accounting. And that's just the way accounting was created, which we talk about a little bit more in Chapter 2 about double entry accounting. It's created in a way to have these checks to be able to get to our balance sheet and make sure that our assets equal our liabilities plus equity. And if they don't, there's an error somewhere in these three statements. So if you missed an account, say you missed rent expense in the income statement, your net income would be wrong. Because of that, the amount you put in the statement of equity is wrong, so your ending balance is wrong. That then carries down here. Now your balance sheet won't balance. So if you get to the balance sheet, you'll maybe see, and it could be frustrating because you don't know necessarily where you've made the error. It could be anywhere in these statements, but at least when you get to that balance sheet, you know something's wrong somewhere because we have that check. Now, seeing this flow, the textbook goes through and it expands the accounting equation. So we won't get into too much detail in this, but it follows the idea of the financial statements. So if we start at the bottom here, we've got our revenue accounts and our expense accounts. And we know those go on what financial statement? Right, on the income statement. So this is really important to know now, to be starting to be able to classify what's a revenue account, what's a liability, what's an expense, what's an asset, and also to know what financial statement they go in. So the first one we do on the income statement, we put our revenues and expenses, we're getting our net income. That, as you can see here, flows up and it goes into our statement of owner's equity. So that's the second line here. So we know we added investments, take away any withdrawals, and add net income. And that gets us to our ending capital balance, which then flows up here. That's second. That ending balance flows up, and it is in the capital account, which goes on the balance sheet. So we show our assets equals liabilities plus owner's equity. So it's just expanding that and showing that flow and the relationship between the statements. All right, we will take a look in our next video at an example of how to prepare the balance sheet.